Hello everyone, welcome to this lesson. And in this lesson we'll be looking at market structure, we'll be looking at market behavior, and also we'll be looking at the overall direction of the market. This is very important because you need to know where the market is going to know when, how to trade, because you must always buy low and sell high. So this is very important. So basically, when we look at the market moves creating structures. All right. So in an uptrend, if we're looking at the market in an uptrend, we see the market begins from what we call an accumulation phase. In this phase, you see the market ranging. Then you see a break, a retest of the structure. A high is created. Okay, a higher low is created. A higher high is created. A higher low is created. A higher high is created. A higher low is created. And then, if the market, once the market failed to create another higher high, and then the current low is broken, it creates a high, a lower high, a lower low, lower high, lower low, lower high, lower low, lower high, lower low, and then the accumulation phase begins again. All right. So in the overall, we'll have a trend to the upside, and then we have a trend again to the downside. So at the end of the day, we have the market structure. So the market moves creating patterns, and these patterns that the market creates form the structure of the market. Okay, so on the basis of this, we see that in an uptrend, the market creates higher highs and higher lows. Higher highs and higher lows, higher highs and higher lows. And then the moment the previous higher low is broken, all right, once the previous higher low is broken and then retested, the market starts creating another form of structure, becoming a bearish structure. So as the market moves, it creates what we call trend, and that is why you see this line here. They call them the trend line. Very, very important. Trend line. And this is how channels are formed. So the market moves, creating channels, and then forming a structure. So this becomes the overall structure of the market. Okay? So this is how the market is. Structure is very important because you see this structure on every time frame that you're going to be using. It appears on every time frame. Every time frame has this structure. All right. So this is what you should be looking at when you look at the market. Every market you are trading must move in a particular direction at some point, and you can determine this direction in any of the time frames. You can use the 4 hours, you can use the 1 hour, you can use the 15 minutes, because structure is structure and it forms in every time frame. So in a structure that is to the upside, this becomes what we call the bullish market. This automatically becomes a bullish market. This is bullish, a bullish trend. So when the market is moving to the upside, it creates a structure called the bullish structure, or you can call it the bullish trend. When the market is going to the downside, it creates a structure known as the bearish trend. And listen, in forex trading, the trend is your friend. All right. If you want to buy low and sell high, you must know the trend. To buy low and sell high, you must know the trend. This is very, very important. As a forex trader, you must know the trend to know the direction the market is going to go next. And then you can look for your lows and your highs to take your entries. Alright, so you must look at the higher time frame, maybe the daily, the weekly, the 4 hours, any of the time frame that is clearer for you according to your trading plan. You need to know if you are a day trader, a swing trader, or a scalper. Alright, of course, with this understanding of market structure, you can be able to break down any chart and know where the market is going. You know whether the market is bullish at a point or it is bearish at that same point. So you can better make a decision to whether take a sell or take a buy, because you must always buy low and sell high. Alright, so in a bullish trend, the market creates higher once the market is in accumulation phase. We call it accumulation phase, or we call it, phase where orders are being gathered. And the market structure begins from the trading session, which we call the Asian session. The Asian session mostly is the ranging time, when the market begins to range. And after the Asian session, you have the breakout of the London Open, and then you see the retest and the continuation, and most of the time you see a reversal in the New York session, which is the last session of the day. Alright, so you must understand how the structure works, because structure is structure. And if you must trade to make profit, you must know the structure at that point. Immediately the market breaks out, it retests and then forms a new trend, breaking the previous high. It breaks the previous high. Alright, then the market moves again. Sorry. Oh, okay. So the market moves again, break the previous high. Market moves again, breaks the previous high. The market moves again, breaks the previous high. But this time around, it failed to break the previous high. Rather, it broke the low. And once the low is broken, the market have to retest that place and then start another trend. Alright, so this is how you know when the market is reversing. Very, very important. Once the previous low is broken, then the market is tend to be in a reversal mode. The market is tend to be in a reversal mode. Alright, so when the market is reversing, it starts creating a new structure, which becomes a bearish trend. So you use your trend lines to know to understand how the market is moving at that point. So this is why the knowledge of market structure is very, very important. Very, very important. It is very, very important to understand market structure. Very, very important. Alright, so another thing you want to look at when we talk about market structure is that the market moves, creating this strength on every single time frame. And also, if you want to look for buys, it is advisable you look for buys in an uptrend. You are not selling in a bullish market. You're not supposed to be looking for sells in a bullish market. Alright, now let's go into another drawing now. So when the market begins to move, what it does is that it creates what we call the push phase. Alright, and then you have what we call the retracement. We don't know how far this retracement will go, we don't know how long this push phase will go. But what we know is that the market has to make an impulse. This move here is called an impulse. It's called what? An impulse move. Let me write it out so that you can get it very clear. It's called an impulse move. Alright, so this is an impulse move. It's called impulse. The market pushes up, and then when the market comes back down, it's called what we call, you can call it a retracement, or you can call it a correction. Alright, you can either call it a retracement or a correction, because the market doesn't move in a straight line. It moves with an impulse, then corrects itself. And most of the time, don't forget this, the market always corrects itself 50% of the previous move. 50% of the previous move. Alright? So the trend is your friend. You must know when to buy and when to sell. So if you want to sell high and then buy low, you must know how the trend is moving. Alright, so when we talk about market structure, we're talking about the ability to recognize the trend. Is it up or down, and what is the structure of the trend? Alright, so quickly let's look at this. So when the market is moving to the upside, it creates an impulse, it creates a retracement, 50% at least of the previous move, and then it has to beat the previous high. This high has to be broken and has to be retested, then moves up. So when you take your levels to check your levels, it has to be 50% of the previous move, because you must buy low. So when the market is at this point, it's already high here, so it has to come back down to a low point in the market. This was the previous high becoming the low. It's being retested, then market continues, and as it continues, the market forms a trend. You connect the lows together, the higher lows. In an uptrend, you get higher lows, and then you can use your Fibonacci tool. I told you about the Fibonacci, very important. It's an indicator that can help you. You take it from the low to the high, the previous high, and then you mark it 50% exactly. That is where you take your buy position to move to ride the market to the upside. So for a bullish trend, this is how you trade. You are not trading if the trend is not clear. If you cannot figure out the trend of the market, there is no need to trade. The trend has to be clear. You have to figure it out in every time frame you are trading, whether the daily, the 4 hour, the 1 hour, the 15 minutes. You have to be clear with the trend. Very, very important. You have to be clear with the trend. That is the only way you'll be able to trade correctly, because the trend is your friend. Don't ever forget that the trend is your friend. All right, and if the trend is your friend, you must know when to buy high, when to buy low, and then sell high. So in an uptrend, you are not expected to sell. No need for sales. You're looking for only buys, and then you must look for the buy positions, which are basically the retest of previous structure. So the price has to be low before you take a buy position. Same with a downtrend. All right, so this is a small secret and it's very powerful. This is how we trade, and this is how you should be trading, so that you don't start donating money to the brokers. All right, so this is how you figure out the trend and then look for a position, where to take a position in the market. All right, so the trend, the market moves, creating impulse, a correction, or what you call a pullback, impulse, a correction, what you call a retracement, impulse, retracement, impulse. Once the low is broken, once this previous low is broken, All right, then the market retest it and then comes down and then start creating another structure, then you know the market has changed its position. All right, so that is what happens, and you know that the market has changed its position. The trend has to be very clear for you, very clear for an uptrend, and then for a downtrend it has to be very clear too. Then you can connect the highs here, the lows, and then here you can connect the lows and then connect the highs, so that you know when to buy and when to sell. So you sell high, you buy low. But like I told us, in an uptrend you're not looking for sells, only looking for buys, and the condition is the retracement has to be 50% of the previous move, not breaking the previous low, and then you can look for rejections and then continuation. All right, so because in our next lesson I'm going to be teaching you candlestick patterns. These patterns will help you to spot when the price is retracing, all right, and when the market is continuing a trend, and when the market is retracing from a trend. Like I said earlier, these trends occur in every time frame. You must be able to spot them clean and clear. But first of all, you must know the overall direction of the market from the higher time frame. This is so important. Don't forget this. Know the overall direction of the market on the higher time frame. The market will always create trends like this when moving. So you must spot the trend, and it has to be very clear. Very clear, or you are not trading. If the trend is not clear, you're not trading, because the trend is your friend. It has to be very clear, and then you can spot the highs and the lows. Then you can know that, okay, I'm to take a sell position from the high, because we sell high and then we buy low. All right, so that is market structure. Very, very important. So when we go back to the chart, now looking at this chart, you can see the market structure on this chart. All right, so you can see from here we have an uptrend, an impulse, a retracement, impulse, retracement, impulse, retracement, an impulse, retracement, impulse, retracement. You see the ranging here. All right, because the market is not going to just give you this all the time. It's not going to just be moving like this all the time. All right, most of the time you're going to see the market move like this. It's going to come down, it's going to go up, go like this, just like this, you know, moving like this, you know. But the major thing is you have to learn how to connect the dots to know where the market is going overall. You have to connect the dots to know where the market is going overall. And then once a previous low is broken and then retested, you know the market has changed its direction. And then you can start looking for a down trend, to start looking for your highs to sell. Is that okay? So the market is not going to give you clear structures all the time. It's going to be zigzag, and most of the time it's going to be very confusing. And sometimes the market will move like this, creating a trend, and then you see it start ranging, it will break out, retest, continue, come back again, ranging, go back, just like this, ranging market, come down, just like that. This is what you find most of the time. But your ability to now begin to decipher this structure and say, okay, the market is moving here, create an impulse low, it was ranging, retest, structure was broken. All right, so we're looking for sells here. Anything below the line here is sells, anything above the line here is buys. And then the market created another high. Okay, fine, the market was ranging here, it broke down. Okay, and then you start looking for things like this. All right, so this is how you should be trading. So once the trend is down, you're looking for sells. When the trend is up, you're looking for buys. So the structure is not going to be clean all the time. You've got to use your wisdom to know what the market is doing, because the market operates in 3 phases, like I told us in one of the last video. We have the 3 structures of the market. We have the trend to the upside, we have a trend to the downside, 3 behaviors of the market, and then you have the range. All right, at this point the market has no clear direction. It's going between the highs and its lows. At this point the market has a clear direction, is going down. At this point the market has a direction, is going up. So it's either the market is going up, is going down, or is ranging. These are the 3 behaviors you will see in the market. So first and foremost, identify the structure of the market, the overall structure. Is it going up, going down, or is it ranging? So if it's going down, it's going up, you look for only buys. And where do you buy? You buy at the lows. If it's going, it's going up. If it's going down, you look for your highs. And where do you sell? You sell at the highs. You wait for the market to come to the highs. You look for your 50% retracement in price, and then coupled with the bearish, with your trend line, you'll be able to know where to sell. Same thing happens here as well. Okay, to the highs, then you look for 50% retracement there. So when the market is ranging, what do? You wait for the market to clearly break out, retest the structure, and then start creating a trend to the downside, or break out to the upside, retest, and start moving to the upside. Then you can now look for your sells, your buys, then you look for your sells. Is that okay? So this is simple enough, understanding market structure. So in our next video, we'll be looking at candlestick patterns, and then we're looking at other things as well. Thank you very much. Alright, so what you do for me now is that you go back to your chart and then begin to look at these structures that the market is creating. Alright, so just look at them, and then you can see the push up down retracement. Then you see the trend to the upside. Alright, you see the trend was broken, and then we have a structure now to the downside. You see it. Alright, you can take your, this is the Fibonacci tool. You can go to indicators, insert. You can go to Fibonacci. Under the insert, Fibonacci, look at retracement, click on it, start from the previous high in a downtrend to the previous low, just drag it from the uptrend to the downtrend, and then you look at it 50%, exactly the push to the 50%. You see the 50% here. So this will have been your entry point. Enter here, and then you will have made so much money to the downside here. Alright, so the trend has to be clear, and then you can be able to know exactly what the market is doing. So look at your charts, go to the back, move back, and then begin to draw your trend lines. Begin to look at the highs and the lows, and then connect your trend lines, and then see where it is broken. Sorry. Alright, let me go back to the 4-hour time frame. See where it is broken, just like this. Alright, so the move, retracement, the move, unable to create a high. The market came down, retested, continued down. So this is epic. This is it. Look at the retracement from here to here. Alright, look at 50% of the previous move. This is exactly 50%. You enter a sell from here, you make money to this place. Okay, so this is just what it is. You have to know how the market is moving, and this, like I said, happens in every time frame. This is the 4 hours. You can go to the 1 hour, and then you see the same thing here. You go to the 30 minutes, 15 minutes. It's just there. So you just need to know how the market moves. This is market structure, the overall market structure, and then you start looking. You can scale down to look at the simple market structures as the market forms. So the market will always move highs and lows to the downtrend, low and highs, lows to the upside. So the trend is up, the trend is down. You have to follow the trend at all times. All right, so do your back test, and then we'll meet in the next class. Thank you.